Welcome to the Accounting 503 Chapter 1 video lecture on tax basics. So the basic tax formula is tax equals tax base times the tax rate. So this is a pretty common looking U.S. federal income tax schedule. This is one for a single taxpayer. And you can see that it's broken down into a series of brackets where the tax is 10% for income between 0 and 95.25, and then it goes to 12% for income between 95.25 and 38.7, and it goes to 22%, etc., etc., etc. to cap out at a top bracket or top tax rate of 37% when income for a single individual taxpayer exceeds $500,000. The 2019 taxpayer tax rate schedule looks pretty similar. You can see that each year they adjust the brackets by inflation. So the brackets are slightly higher than they were last time, 9,700 versus 9,525, and at the very top end, 510,300 versus 500,000. So SpongeBob has taxable ordinary income of 75,000 in 2008. What is SpongeBob's U.S. federal income tax? Well, let's go out to Excel to calculate that. Okay, so I've created the single taxpayer table for 2018 over here, just so we can see it. So let's start with SpongeBob's 75,000 of taxable income. 75,000 fits inside this bracket. So we would take 75,000 minus 38.7, multiply that by 22%, and then add to that the 4453.50 to get a total tax liability of $12,439.50. That creates an average tax rate, which is the tax liability divided by taxable income of 16.59%. And say, what if instead SpongeBob had taxable ordinary income of $275,000? What is his U.S. federal income tax? Okay, so if it's $275,000, well, now we fit inside this bracket. And so we're going to take 275 minus 200,000. That's 75 times 35%. 26,250 plus 45,689.50 or 71,939. In this situation, SpongeBob's average tax rate would be 26.16%. So you can see that we have a progressive tax rate structure for income taxes in the U.S. As income goes up, the rate by which it is taxed also goes up. So even at a flat rate, the tax that you would pay would go up, right? If the rate stayed at 10%, if SpongeBob made 75,000, he would still pay more at 275,000 as a tax amount, but his rate would have stayed the same. In this case, his rate is actually increasing. We call that a progressive tax rate structure. Another important tax is the Social Security tax. And I've displayed the Social Security, or I should say, the employment tax rates here, which includes both Social Security and the Medicare tax. And you can see that the rates go, it's 6.2% for the employee share and the employer's share, a total of 12.4 for every dollar of wages up to 128.4 in 2018. Medicare, on the other hand, is 1.45 for each employee and employer. But then starting at 200,000 for a single taxpayer, 250,000 for married filing joint, the employee share goes to 2.35. That's an additional 0.9% tax associated with the Affordable Care Act. For 2019, what happens is this number increases. So this is called the FICA cap, and it's the amount at which Social Security tax applies, because you can see it goes to zero after you crest that dollar amount. So in 2019, the FICA cap is going to increase to 132.9. So if SpongeBob has wages of $75,000 in 2018, what is SpongeBob's employment tax? And what about the employment tax of his employer? All right, let's go back to Excel and take a look. So I've presented the Social Security tax table over here for 2018. So let's calculate out both the employee share and the employer share. So let's start with the Social Security rates of 6.2 and 6.2, right? So we can calculate the employee share as 75,000 times 6.2. We can calculate the employer's share as 75,000 times 6.2 for a total Social Security tax of $9,300. Medicare works very similarly. The employer's share, the employee share times 1.45 for a total Medicare of $2,175. There's no additional medical surtax associated with the Affordable Care Act, so the total is $11,475 for an average tax rate at $75,000 of 15.3%, which we really could have confirmed that right here. So the 15.3 is simply the 12.4 of Social Security plus the 2.9 of Medicare. What if instead SpongeBob had wages of $175,000? Now let's see if we can calculate his employment taxes. At $175,000, now SpongeBob's total wages are in excess of the FICA cap. Remember that Social Security tax only applies up to the FICA cap amount. In 2018, that was $128,400. So as a result, his tax is only on the $128,400, not on the full $175,000. So you can calculate the employer and the employer's share. However, the Medicare tax is not subject to the same FICA cap and instead applies on the entire $175,000, right? So it's rate times base, rate times base. So we can total those together and see that SpongeBob's tax on $175,000 of wages is $20,996. Now that's obviously more than it was at $75,000, but notice that the average tax rate is going down. That's because employment taxes, Social Security in particular, is a regressive tax. The higher the base goes up, the lower the tax rate. Now admittedly there are only two brackets, but once you crest the FICA cap, the rate goes to 0%. What if, on the other hand, SpongeBob wages go all the way up to $275,000 in 2018? At $275,000, the FICA cap still applies to Social Security. And so you can see that his Social Security tax is identical to the tax when he made $175,000 because both of those amounts are above the $128,400 FICA cap. His Medicare insurance, however, all $275,000 is subject to the 1.45%. But recall that for a single taxpayer, anything in excess of $200,000 is subject to an additional 0.9% tax. So we take that excess amount and subject it to the Medicare, sometimes called surtax, of 0.9%, which only applies to the employee. It does not apply to the employer. That generates another $675 of tax. And you can see that SpongeBob's total tax is $24,571. But the regressiveness of the Social Security portion of the employment taxes continues to drive his average tax rate down. So what we've learned is there are progressive tax, which imposes an increasing marginal tax rate as the tax base increases, a regressive tax rate, which imposes a decreasing marginal tax rate as the tax base increases, And then there's something called a proportional or flat tax, which imposes a constant tax rate throughout the tax base. So if we look at the employment tax rates, you could argue that Social Security tax is definitely regressive. As the base goes up, the rate goes down. Medicare was, for years, a flat tax. It was proportionate. It was a flat 1.45%. With the advent of the Affordable Care Act, there now is a slight progressivity to the portion that relates to employees, whereas the employer's portion remains a flat or proportional tax. Okay. So Patrick, who is SpongeBob's friend, has taxable income of $65,000 and also earns $10,000 of interest income on tax-exempt municipal bonds. What is Patrick's income tax? So Patrick's taxable income is only $65,000. So in this case, even though he's generating $75,000 of income, his taxable income is only $65,000. We can put this into the rate schedules. It falls within this bracket, and calculate Patrick's tax to be $10,239.50. His average tax rate is only 15.75%. However, if we were to compare SpongeBob with Patrick, we would see that Patrick's average tax rate is lower. But what that doesn't consider is that Patrick has $10,000 of non-taxed income. His total income is $75,000. His effective tax rate, which is the tax liability divided by total income, both taxable and tax exempt, is only 13.65%. Okay, so we can look at this and say, hey, that's a pretty good comparison. It looks like Patrick is doing much better than SpongeBob because his effective tax rate is so much lower. In some instances, the comparison of the effective tax rate or even average tax rate doesn't completely capture what we're after. We should note that when we're doing tax planning, the ultimate goal is maximization of after-tax cash flows. And you can see that when I compare Patrick's, his after-tax cash flow is $64,760, whereas SpongeBob's is only $62,560, for a difference of $2,200. Where does that $2,200 come from? Well, primarily that Patrick receives $10,000 on which he pays 0% tax. Whereas SpongeBob, recall that they're in this tax bracket, his $10,000 is taxed at 22%. We call that the marginal tax rate. That's the tax rate on the next dollar of income or dollar of deduction if that should apply. Let's see how marginal tax rates work. So if I take SpongeBob's income and I give him one additional dollar of income, he now makes $75,001. We can see that we would run it through the brackets and calculate out that his tax is now $12,439.72. The difference between his original tax and his current tax is 22 cents. Why is that? That dollar is taxed at 22%. Again, that is his marginal tax rate. Well, what if it were $2? You can see that with each dollar we increase it, it's multiplied by 22%. But at some point, we're actually going to eclipse 22% and slide into the next bracket, into the above 82.5. When do we get there? In this case, we would get there with an additional $7,501 of income, because that would push SpongeBob from $75,000 up to $82,501. We can see now that when I recalculate his tax, the 160.50.24, wait a second, that still reads 22%. How can that be true when the marginal tax rate is 24? Well, it's simply that that amount is so close to 22% that the rounding doesn't get picked up. All I have to do is start to change it a little bit more, and very slowly we start to move away from 22% and up towards 24%. So at some point, that 22% is going to shift completely to 24% as a marginal tax rate. We can see that what happens is with each dollar that goes up, it's taxed at the rate that applies to that bracket. So if we're to calculate the amount of each bracket, we would see that the first 95.25, the tax on that is 952.50. The next bracket's worth from 38.7 to 95.25, that's another 35.01 of tax for a total of 44.53. Notice that is the exact same amount you add to the excess over 38.7. Then when I go from 38.7 to 82.5, I add another 96.36 of tax for the dollars between 82.5 and 38.7. That totals $14,089, which is of course the amount we add in for every dollar above 82.5. So you can see that as we progress down through the tax rates, what happens is the rate becomes progressively higher, and the table builds in all the tax that you would be charged on the amounts underneath the bracket you're sitting in. So at some point, 75,000 becomes 157.5. And you'll see that we get very close, but not all the way to 24%. Because at the same time, there's still $10,000 or so being sheltered before the first $7,500 that's still being sheltered between the 75,000 and the 82.5 that starts the next bracket. Corporate taxes, on the other hand, are now proportionate. It's a flat 21%. So no matter how much corporate income you generate, a corporation will pay tax at 21%. So if SpongeBob is a corporation, at 75,000 times 21%, 15,750. At 175, it's still just times 21%. The marginal and the average rates are the same as income at all levels is taxed at a flat 21%. Okay, now we understand the average tax rate is tax liability divided by taxable income. The effective tax rate is tax liability divided by total income. The marginal tax rate is the change in tax divided by the change in income. However, that's often just the amount of the tax rate in the bracket in which an individual is sitting. Okay, now let's look at some other taxes. We'll start with state taxes. So, of course, the state of California and many other states have an income tax. Here's an example of what the 2018 California state income tax rates are. You can see that California's income tax rates are also progressive. They're just at lower amounts. Interestingly enough, when California publishes its tax rates, it always leaves off the additional 1% of income 1% on income over $1 million. So actually the top marginal rate is actually 13.3%. That's called the Mental Health Services Tax and was passed a few years ago by the voters of California. So how does California rank on individual income taxes? Well, suffice to say, California is known as being a high tax state. We are ranked 49th out of 50. If you're wondering what number 50 is, it's over here. It's New Jersey. So if we look at the Business Tax Climate Index, so the Business Tax Climate Index is something that examines taxes, both individual business taxes, corporate taxes, sales taxes, a number of different taxes as a complex algorithm. You can see that California remains 49th. So we, again, are one of the highest taxing states, with New Jersey, again, the very worst. So if you're just out of curiosity, if you wanted to look at some of what are the components of the business tax climate are, it includes the corporate tax rank, the individual tax rank, which I showed you earlier, sales tax, property tax, and an employment tax. And you can see that for the most part, California is pretty high on most taxes. If you're curious, you can go back and look. Typically, the number one state is Wyoming. So if we were trying to think about what is the total tax burden on wages, if we have a single individual who's pretty well off, $2 million of taxable income from wages, the federal income tax on that would be about $700,000. Employment taxes would be about $90,000. And state income taxes would be about $256,000. So the total income tax burden would be about 52% on someone who makes $2 million. So that's a pretty hefty chunk, but someone who makes $2 million, they're probably still doing okay. Okay, other types of taxes are transfer taxes. So transfer taxes is a combination of a gift tax and a death tax mixed together. So it's a tax on the transfer of wealth either by gift or by gift at time of death. And this tax is on the giver, not the recipient. So if someone gives you something, that is actually tax-free to you. Although when we get to income tax, we'll see if it's from your employer and some other things, whether that's gifted or not starts to become a question. But in any event, if it's a true gift, that is not taxable to the recipient. There are three primary exclusions from the transfer tax. The first is the marital exclusion, and basically you can give you can give all your assets to your spouse and not pay any transfer tax. There's also an annual exclusion of up to $15,000 per donee, and that $15,000 is a number that changes, not each year, but is adjusted for inflation for every thousand. So a couple years ago it was $14,000, then it was $13,000, but right now I believe it's $15,000 in 2018 for sure. And that is from each individual donor and per donee. So for example, if I had 6 cousins, I could give each of them $15,000. My spouse could give each of them $15,000. So collectively we could give them $30,000 each. And then there's a big credit called the unified credit. And basically that credit is a tax credit against any transfer tax you would pay. And it translates into more or less a deduction of about $11 million. So what that means is you would need to give away either over your lifetime or in a single lump sum, either during life or at death, over $11 million before you'd pay a dime of tax on transfer taxes. So this is definitely a tax for the wealthy. So the gift tax formula says go ahead and add up all the gifts you've made during the year and then exclude that $15,000 per donee. So for example, unless you're reasonably affluent, all the Christmas gifts that you give and birthday gifts that you give and all those things, those are clearly swept out as being less than the exclusion amount. You would then deduct the gifts that were made to your spouse that you're taking a marital deduction for. And then to the extent those gifts are charitable contributions, those are also not includable in your taxable gifts. Then you add to that all the gifts you've made in all prior years. That's taxable gifts that you've made. And that's your cumulative gifts over time. So think of that as your inter vivos, which means during life, gifts over your entire lifetime. Multiply that by the tax rate, and then calculate your tentative tax. And then you would subtract out that unified credit that you're eligible for, or any transfer taxes you'd paid in prior years, and that would give you any amount of gift tax that you would owe in the current year. Now, you can choose to use your unified credit or not use your unified credit. For example, if you truly were affluent and you thought, well, look, I've got $50 million I'm going to give away over my lifetime, you could decide to give this away now and go ahead and pay the gift tax on it, and then use all your unified credit later on for some other reason. On the other hand, you could certainly use part of your unified credit now, and then you'd have less to use later on. So transfers at death are based on the estate value. So first you measure the gross estate, which is the fair market value of all the property owned by the person that died. You get to deduct out some administrative costs, charitable contributions again, and anything that you transfer to your spouse. That leaves your taxable estate. You add to that any of the gifts that you've made since 1976, and since most of you are clearly too young to have been born before 76, and I haven't even met you yet, I'm going to assume that that's all of your taxable gifts. Now that's your tax base. Multiply that by the transfer tax rate. You get the tentative tax, and again, you're eligible to deduct any tax credits. And in 2018, the deduction is equivalent to $11,180,000. And then you deduct any gift taxes you've already paid on those transfers, and that would be your transfer tax or estate tax, sometimes called due. So estate is typically property at fair market value at time of death. There is an alternative date for valuation if the value of the estate becomes lower and results in lower tax liability. And that alternative date is 6 months after the date of death. And notice how taxable gifts become part of the unified transfer tax calculation, right? So what happened is originally there was simply an estate tax. Taxpayers are fairly astute, or at least their tax planners are, and they said, hey, don't wait till you die, give it away before you die. And so Congress had to write the gift tax as well to capture gifts during life. So you can see the transfer tax rates are fairly progressive. The taxable estate at over $1 million goes to 40%. But as a function of the unified credit and the way that works, the applied rate is almost always, in all instances, actually 40%. So think about it as what happens is even though you get to take the unified credit against $11 million of your estate, that $11 million includes this 0 to $1 million that you see here in the transfer tax table. So as a result, the rate is almost always 40%. Okay, note that estates and trusts can also generate income. So if someone dies and let's say they own stock or they own bonds, those stocks and bonds continue to pay dividends. And so until the estate is wrapped up or the trust is distributed, the trust assets are distributed, the trust or estate can actually earn income. And as a result, it also is a tax-paying entity or an income tax-paying entity. And this is the 2018 tax rates for trusts and estates. And you can see they are extremely progressive, which is income over $12,000 is paying at 37%, which is the top marginal rate for individuals. That's going to become important when we do kiddie tax next chapter. Okay, another type of tax is the property tax. And property taxes on real property or real estate, these are very common, and many states have them. There can also be property taxes on personal property, which is everything but real estate. So think of that as furniture and fixtures and cars and things like that. Those are less common except on aircraft, cars, and boats. Many states do apply a personal property tax against those three items, and I think it's largely because of their cost. So property taxes are generally based on value. That's called an ad valorem tax. However, here in California, we're lucky enough to have something called Prop 13. And under Prop 13, the annual real estate tax on a parcel of property is limited to 1% of its assessed value. Now, that's not that unusual. It's pretty common for property taxes to be capped at 1% in a lot of states. Some states have a 1.5%. Some states have a 2%. What's unique about California is the assessed value. So the assessed value can be increased only by a maximum of 2% per year until and unless the property has a change of ownership. So what Prop 13 does in California is if you bought your property on Coronado Island back in 1976, when it was probably worth about $60,000, even though today it would be worth $2.5 million, you're still paying property tax on its assessed value of probably $65,000 plus 2% a year for the last X number of years. Whereas the price of that real estate has increased, or the value of that real estate has increased much more than 2% since that time. So at the time of a change in ownership, the low assessed value may be reassessed to to a complete current market value, and that creates a new tax base. Future assessments then are restricted to the 2% annual maximum increase. So if you were unlucky enough to purchase your property in, let's say, 2007 at the peak of the market, your property is probably stuck at a high value. Now, I typically get a question that says, can you go in and have that reassessed at a lower value if the value of your property has gone down? And the answer is yes, you can. Okay, so here's the average rate since January of 1987. This is for San Diego, the average home price, and you can see that it's actually increased almost 5% per year since January of 1987 through, I think this was as of December of 2018. So the 2% clearly is not keeping up with an actual increase in value, but hey, that's Prop 13, and that's how it works. Okay, so here's how your property taxes are spent in case you wondered where property tax revenues went. You can see the largest share goes to schools. There's a small chunk that goes to the library. There's a fairly sizable chunk that goes to pay for county-based services like courthouses and sheriffs, things of this nature. County in lieu of a vehicle license fee is a swap out for a different kind of fee. There's redevelopment property tax trust fund. These were used for redeveloping properties that had become run down or needed sprucing up. Then there's a little bit for special district cities, and then cities in lieu of the vehicle license fee. So here's what a property tax bill looks like. I've blacked out the owner in this case, but I won't lie to you, it's my property. So you can see the land is assessed, improvements are assessed, because what happened is when I purchased this property, it had a home on it, but I've made improvements to it since then. And so anytime you pull a building permit, more or less the county has the right to reassess your property. And I did do some work on my home, and so as a result, you can see there's a homeowner's exemption. That's a whopping $7,000. That was probably meaningful when home prices were $50,000 on average. Today, that's almost meaningless. Okay, so here's how your property tax bill is distributed. So you can see that top line, 1% tax on net value. So let's go back. You can see my net value is $1,043,000. $1,043,000 times 1% is the $10,430. It's missing a penny for rounding. And then you can see all the other things are what you would generally call an override. So these are bonds that were approved by the voters in the district in which I live. Largely unified bond for Poway. That's the Poway Unified School System to pay for schools. Palomar Community College, Prop M. We passed a bunch of bonds to pay for community colleges. And then there's the Metropolitan Water District. And then there are also a number of fixed charges that are collected through property tax. So mosquito surveillance, that's the spray for bugs in case we need it. There's a Poway roadway, fire tax, again, the water district, some emergency radio equipment. There's landscaping, a vector for disease control, that's spraying for mosquitoes generally, and more roadway work. So you can see the voter approved charges are about $1,100 a year. The other assessments are $342 a year. And if you want to know more about property taxes, I posted a really well prepared reading for property taxes in California as an optional reading in Blackboard under Module 1. So here's another type of tax, which is sales and local tax. So sales and local taxes are varying, but you can see the vast majority of cities charge 7.5%. We'll break down some of these differences shortly, but you can see some differences. So San Diego is 7.75%, but for example, National City is 8.75%. Let's see, who else is here in San Diego County? Del Mar is 8.75%. La Mesa is 8.5%. Vista is 8.25%. So when you think about what is the breakdown of our sales tax, 3.6875 goes to the state's general fund, and that's very old. And then there was an additional section that was passed for an additional 0.25% for the general fund. There's a 0.5% that goes to local public safety funds. There's another 0.5% that goes to local revenue funds to support local health and social services programs. There's another 1.06% that goes to the local funds. And then there's 1.25%, of which 0.25% goes to county transportation, and then another percent goes to city or county operations. So that's the 7.25 of state and local taxes. So you can see that the vast majority of it goes to the state, but 1.25% goes to the local community in which you're paying that sales tax. Additional cities layer additional tax on top of that. So you can see that in San Diego County, there's a 0.5% tax. That takes us to the 7.75 that we're used to seeing everywhere in San Diego County. And then you can see some of these additional fees, like there's the Del Mar, City of Del Mar transactions and use tax, the National City transactions and use tax of 1%, and La Mesa's as well. These are all additional taxes that are layered in on top of what we've already seen on the last slide. There are also excise taxes. So probably the biggest excise tax that we see as consumers is the gasoline tax. So if you're interested in seeing what tax is included currently, or as of this July 2018, there's an 18-cent tax on federal fuel. That's per gallon. The state charges almost 42 cents a gallon. And then there's also a sales tax layered on top of that. So, for example, if you buy gas in San Diego County, not in one of the special places, you're going to pay another 7.75% on the sale of gasoline at its retail price. So there are also other excise taxes. If you get new tires, you pay a tire tax. That's to pay for the disposal of your old tire. There's a cannabis tax, of course. There's a tax on alcoholic beverages. There's a fairly healthy tax on cigarettes, and a number of other smaller excise taxes. So another tax is unemployment taxes. So this is a combination program between the federal government and state governments. And it's a tax of 6% on the first $7,000 of wages. That 6% is paid by the employer, or at least the cash is paid by the employer. There's no withholding from your paycheck. But the federal government permits a credit for state unemployment taxes of up to 5.4%. However, that credit can be reduced. So the way unemployment taxes work is the amount is collected from employers and it's put into think of it like a trust fund or a lockbox. And then when someone claims unemployment benefits, it's paid out of that lockbox to that employee. When times get particularly tough, the states may actually spend all of their lockbox. Then what happens is they tap in to the federal government's unemployment lockbox. So basically they borrow from the federal government. So California, for example, starting in either 08 or 09, became a borrower for the federal government. As you know, the financial crisis hit this state fairly hard, and there were a number of people unemployed. California is also a fairly high service state, so we pay a fairly good unemployment benefit relative to other states. And so as a result, we had to borrow from the federal government. I think it's effective in 2018. California has finally paid back that loan to the government by collecting additional amounts from employers since then. So there's also an employment training tax. That's in California only. And California has something called the State Disability and Family Leave Act, which is California SDI, which collects money from, again, employees in this case, to help pay for disability and family leave. So if you were curious about what happens with all these taxes, this is a handy chart that's provided by the state of California that shows what these taxes are, what they're for, and what they're spent on. And feel free to read that at your leisure. Okay. So lastly, I want to change directions in a big way and talk about good taxes. So the end of this chapter talks about something called a good tax. And if there is such thing as a good tax, then these are the characteristics that would describe it. So when people admit they have to pay taxes and they say, okay, well, if you have to pay taxes, how would you like them to be characterized? These are some of those characteristics. And the first one is equity or fairness. And you can break down equity into two pieces, either vertical equity or horizontal equity. Now, horizontal equity is the easier of the two, and it simply means that people that generate the same amount of tax base should pay the same amount of tax. So, for example, if you had taxable income of $100,000 and I had taxable income of $100,000, it would be patently unfair if I paid less in income tax than you did. Vertical equity, on the other hand, says that people who generate a greater base should pay more in tax. So vertical equity comes through either the use of a flat rate, where just as the base goes up, the amount of tax they pay goes up. But vertical equity also includes a progressive tax rate, which is when the base goes up, the rate at which tax is paid also goes up. So as a result, vertical equity is based on this notion of ability to pay. And I'm not going to break down ability to pay extensively, but if you're interested, there's plenty of tax policy research on the notion of ability to pay being an important part of equity when it comes to trying to characterize a good tax. So certainty means that the tax generates sufficient revenue for the government to operate and that it's predictable. Now, predictable doesn't mean down to the cent. It means you have some reasonable idea that you could forecast what your tax burden is going to be for the year. And you could contrast this with, 3,000 years ago. Okay, well, that's maybe overstating it a bit. Maybe 2,000 years ago or 1,000 years ago when the royalty would decide how much they needed based on how much they needed at that moment. And so they just send out tax collectors when they needed revenue, as opposed to there being some sort of annual charge. So certainty is being predictable. Convenience means that it's easily administered. So, for example, the sales tax, at least for consumers, is fairly easy. We are charged it, we pay it, or we don't get the good, and it's remitted to the state. Now, you might say the business has a bit of a burden as it comes to sales taxes, but for the most part, that's considered an easily administered tax. Whereas estimated tax payments for a self-employed individual, that's considerably less convenient. They have to calculate what their estimated tax income is, then use that to calculate their estimated tax, and then make a payment separate from some form of withholding system. An economical tax is one that is low cost to pay and low cost to collect. So generally, the U.S. income tax really costs less than a penny per dollar to collect, so it's considered quite cheap. And then lastly, simplicity, and this is undoubtedly where certainly federal income taxes fail. There's nothing simple about federal income taxes, which is why many undergraduates getting a bachelor's degree in accounting have to take 6 units of income tax. So we got to spend a lot of time trying to figure out how taxes work. Okay, so what kind of entities are there in the federal income tax system? So you can think of it as there are two types of taxpayers. There's individuals and there's corporations. And within individuals, I'm including trusts and estates. So then there's a number of other flow-through entities like sole proprietorships, partnerships, S-corps, LLCs, and certain trusts if they're distributing all their income to their beneficiaries. So this is what the individual calculation of income tax and tax due from looks like. So you calculate total income. You exclude anything that is excludable from income to get to gross income. Then you take any deductions for adjusted gross income. So those are deductions that appear before adjusted gross income. Adjusted gross income is a subtotal. Then you take your from AGI deductions, which are currently your itemized or standard deduction, whichever is larger, and the QBI deduction, or qualified business income deduction, or as some people say, the 199 Cap A deduction. That gives you your taxable income. Multiply that by the tax rates. You get your income tax. You take any tax credits you're due. You pay any special taxes on top of that. Then you deduct any payments you've made from your total taxes, and then you either owe or are due a refund based on your filing. So when you think about it, the tax return itself is really just a truing up process. It's when we determine the due to, due from with the government jurisdiction to decide whether we owe them money or do they owe us money now that it's the end of the year, and we can calculate accurately our tax liability. So in the old school world, individuals used Form 1040EZ or 1040A or a Form 1040. The new school, starting in 2018, is there's only a Form 1040. The EZ and the A are gone, but they've been shortened, and now there are Schedules 1 through 6 that you should file as needed. So that's separate from Schedules A, B, C, and D, or E if you're familiar with those. Those also still exist. So they took the old 1040 and blew it out into a number of smaller schedules. So now page 1 of the 1040 is really only information. So taxpayer information and dependent information. It's only on page 2 of the 1040 where we start to put amounts on lines. So just a quick glance through, you can see on line 1, wages, salaries, etc., things that come from your Form W-2 if you're an employee. And then interest, dividends, pensions, Social Security benefits. Line 6 is your total income. If you have any other forms of income, you can see on line 6 it says add any amount from Schedule 1, line 22. There's Schedule 1, line 22. You can see it's a number of other forms of income that you combine together on line 22 and then bring forward to the 1040. So think of the 1040 as being a summary report that gathers information from all of these subsidiary schedules. Adjusted gross income is on line 7. Then you take your standard deduction or itemized deductions. There's your qualified business income deduction. And on line 10, taxable income. Line 11 is where you calculate your tax. Line 12 is some credits. Line 14 is other taxes that come from a subsidiary schedule. Then you get your total tax. And then you add up whatever was withheld and whatever you've paid in. Think of that as your total payments, which end up on line 18. And then lines 19 through 21 or through 22 are your due to, due from. Either you're due a refund or you owe. So again, Schedule 1, the top part of Schedule 1 is a number of additional income items. The bottom of Schedule 1 is those 4 AGI deductions. And don't worry, we're going to go through all of these in detail. But there's a number of things that are deductible before AGI. And you'll notice that you're going to take line 36. Let's go back to the 1040. If you look at line 7, it says adjusted gross income. Otherwise subtract Schedule 1, line 36. So this is the place in which you would deduct whatever total you created on line 36. Schedule 2 is a number of all different types of taxes. Not many things on here. Basically the alt-min tax and the advanced premium tax credit that you have to repay. Schedule 3 is a list of non-refundable credits, and we'll spend more time on credits as we work through the course. Things like the education credit is on here. That's an important one. And then Schedule 4 is other taxes, so self-employment taxes, household employment taxes, and if you owe any of those Affordable Care Act taxes, like we talked about in employment taxes earlier in the video, those are reported here as well on line 62. Schedule 5 is for other payments. So we saw that Schedule 5 picked up withholding. You accumulate other types of payments here. They tend to be a little more rare other than estimated payments, but you accumulate these, and then it says right on line 75, enter here and include on Form 1040, line 17. There is a Schedule 6. It has to do with a foreign address. Very few taxpayers are going to use Schedule 6. Okay, so we still follow the same pattern that I displayed before. It's broken up a bit amongst those schedules. So again, you can see gross income for the most part comes through the 1040 itself, but then Schedule 1 picked up items of gross income. Deductions for AGI were on the bottom of Schedule 1. The itemized and standard deduction were right on page 2 of 1040. The QBI deduction was right on the face of the 1040. Income tax and the credits were calculated right on the face of the 1040. And then, of course, that due to, due from. So let's think about the concept of a flow-through entity. So let's say Bob has a portfolio of investments that pay interest and dividends. Bob is also a wage earner, and Bob's a busy guy. He also runs a small business out of his garage. Now, all of these are generating some form of income, which means all of these need to end up somehow on Bob's 1040. So interest and dividends come through what's called a Schedule B. Wages, as we saw earlier, would be reported directly on Form 1040. And small business profits come through a Schedule C. In all cases, Bob reports these items directly because there's no separation between that activity and Bob. Bob is the owner of all these activities. And let's just flip back a second because I want to show you where Schedules B and C end up. So you can look here on line 12. Look, that's where Schedule C rolls through. Right? So if you have a small business, if you're self-employed, your income from that business is reported there. Whereas your Schedule B items, which are interest and dividends, would be reported on lines 2A, 3A, 2B, and 3B. So they're not included as a total, but instead the total interest and total dividends separately. Okay. The flow-through, on the other hand, has Jane. So Jane's a wage earner, but Jane also owns an interest in a partnership. And that partnership is the entity that operates a small business. And that partnership also has some investments that pay interest and dividends. But just like Bob, Jane needs to report these items of income or deductions as well. But a partnership is not a taxable entity. It is a flow-through entity. It pays no tax. But it, of course, needs to inform Jane, and ultimately generally the IRS, of the share of income or deductions that Jane is being allocated from that partnership. So to do that, the partnership will prepare a tax return, but it doesn't pay any tax. That partnership is an entity apart from its owners. So that means that customers and suppliers are doing business with the partnership, not directly with Jane. The character of that income remains the same and is passed from the partnership to Jane. So if the partnership earns interest, it allocates a portion of that interest to Jane, and Jane treats it as interest. If the partnership generates dividends, then it allocates a portion of those dividends to Jane, and Jane treats it as dividends. If the partnership generated capital gains, the same. It will report them to Jane as capital gains. Income is allocated to owners, and cash is distributed to owners, but these are not the same. So if Victoria is allocated $20,000 of income from Moldova LLC, she also receives a cash distribution of $10,000. How much taxable income must Victoria recognize? Well, the answer here is only $20,000. Generally speaking, because she has allocated that income and includes it on her tax return, when she receives the cash distribution, it's almost likely to be out of that income. And for her to pay tax on it again would be to create double tax, which defeats the purpose of a flow-through entity. Jill is a wage earner. And Jill also owns 100%, although it doesn't matter, it could be 50%, 10%, or 1%, of a corporation. That corporation operates a small business, and that corporation earns interest and dividends on the investments. So Jill is just like Jane. She owns a business, except Jill's business is operated through corporate form, whereas recall Jane's was operated in a partnership form. The difference is a corporation is a tax-paying entity. And this used to be the price for having limited liability. A corporation does file a tax return, and it also does pay tax. Unlike the partnership, corporate income does not flow through to its owners until it is paid. The character of the income is not retained. So if the corporation earns a dividend, it's actually paid out as a dividend. But if the corporation earns interest, it's paid out as a dividend. If the corporation earns ordinary business income, it's paid out as a dividend. If it earns capital gains, it's paid out as a dividend. The result is when the owners are paid their share of income, double taxation results in the corporate form. So trusts, are they flow through or not? So notice I mentioned them both in both categories. And the answer is, of course, it depends. If the income is in fact distributed to the beneficiaries, then generally there's no entity level or trust level tax. If that income is not distributed to the beneficiaries, then it is taxed. And then there's two unusual business forms. One is called a real estate investment trust, and the other is a regulated investment company. These are both business forms of a trust, and they have special rules which we're not going to engage in at this point. Okay, the book also talks about tax law and the three types of sources. I'm not going to beleaguer this topic. I think the book does a fine job with it, so my suggestion is go read that part of the book. You should have read it already, and just pay attention to that. One of the things I do want to draw your attention to is something called the statute of limitations. So this is the last chance to make a change to a properly filed federal income tax return, and that's on either the part of the government or on the part of the taxpayer. So generally speaking, the statute of limitations is 3 years from, not from the later of the original due date or the date the return is actually filed. However, there are two exceptions. If there's a giant omission, then the statute of limitations is extended to 6 years. And a giant omission is one that is considered greater than 25% of the taxpayer's gross income. And the other exception is for fraud, in which case the statute is extended indefinitely. So Betty filed her 2017 tax return on March 23, 2018. She reported gross income of $100,000, but she failed to report $25,000 of additional gross income. When does Betty's statute of limitations expire? Well, the answer is she did fail to report 25% of her additional gross income, but she does not trigger the exception because it needs to be greater than 25%. And I only point this out because the tax code is full of terms and clauses just like this. So exceed or greater than is not the same as equal to. So Betty's statute of limitations expires with the typical statute of limitations, which would be the later of the date she filed it or its original due date. The original due date of a 2017 tax return would have been April 15th of 2018. As a result, it's going to statute of limitations extends until April 15th of 3 years after the original due date, or April 15, 2021. Okay, so taxpayers are subject to penalties and sometimes interest for failure to file and or failure to pay taxes. So the failure to file is 5% of the net tax due, up to a maximum of 25% of the net tax due. Failure to pay is 0.5% of the net tax due, up to a maximum of 25%. And those two are actually considered jointly. So really, if you fail to pay and you failed to file, the 5% is going to subsume the 0.5%. A bigger mistake costs more. So if you have a large error, that's a 20% penalty, and fraud is a 75% penalty. Okay, so yeah, we get it. Taxpayers are subject to penalties. Note that tax preparers can also be subject to penalties. So Betty, this is a different Betty, overstates a deduction and owes additional tax of $500. So what is the tax preparer's responsibility who prepared Betty's tax return? So that is, what is the professional responsibility of a tax preparer with respect to a tax return? So Betty asks whether a certain expense is deductible, and Sally, her CPA, says yes. It turns out that it's not deductible. What is the tax preparer's responsibility in this case? So what we need to understand are, what are the responsibilities for tax preparers? So tax preparer behavior is controlled through 4 types of regulation. The first is Circular 230, which is issued by the Treasury Department. That is a regulation. The second is the ACCTG Statement on Standards for Tax Services. The third is Internal Revenue Code Section 6694, which is, of course, law. And then in California, the California Business and Professions Code and any regulations there too would apply as well. And there's Division 3, Chapter 1, Sections 5,000 in the 5,000s. That's called the Accountancy Code, and that's for CPAs. And then Division 3, Chapter 14 is for what we would describe as unenrolled tax preparers. Okay, so let's start with the ACCTG. And the AICPA standard number 1, by the way, these are posted for you to read in Blackboard. A member should determine and comply with the standard, if any, that are imposed by the applicable taxing authority. So what that says is whatever standard is applied by the taxing authority is the standard by which an AICPA member needs to live by. And that's with respect to recommending a tax return position or preparing or signing a tax return. So when we think about, is that item deductible? Right? So what needs to happen is, what was her name? Sally, the CPA, needs to determine what is the standard that the taxing authority imposes on me as a tax preparer. If there is no standard, or the taxing authority standard is lower than the previous standard, then the following standards apply. Okay, you shouldn't recommend a tax position unless you have a good faith belief that it has at least a realistic possibility of being sustained. If, on the other hand, you conclude that there's a reasonable basis for it and you disclose it, then an AICPA member may recommend that tax return position. Okay, so we get it. If there's no standard, then it's realistic possibility. If there's no standard and you disclose it, then you need only have a reasonable basis for that. Otherwise, you have to follow the taxing authority standard. So what is the taxing authority standard? Well, you'd argue that's issued in Circular 230. So the Treasury Department has issued 230 as a regulation concerning practice before the IRS. So why don't you take a moment and read what practice before the IRS means. Okay, Circular 230, it looks like practice before the IRS is a pretty broad definition. It's basically everything. So it looks like we're going to have to live by 230, even if we're solely a tax preparer. However, that is not true. So let's go to Circular 230, Section 10.8, preparing all or substantially all of a tax return. Take a moment and read this slide as well. Okay, this seems to say that anyone who's preparing a tax return for money has to be an attorney, a CPA, enrolled agent, or registered tax return preparer. However, there was a court case in 2011, and the court case is called Loving et al. Versus the IRS. And then Judge Brett Kavanaugh declared that Circular 230's inclusion of tax return preparers was a regulatory overreach. And as a result, Circular 230 does not apply to individuals that only prepare tax returns. So even though this was overturned back in 2011, the IRS has not reissued that regulation. It hasn't been updated to reflect the new law. Application requires representation of a client in a proceeding. So Circular 230 doesn't apply unless you are representing a client in a proceeding in front of the IRS, which basically means representing them as part of a court case. You can actually, under Loving et al., you can represent your client if you prepared the tax return itself. Okay, so Section 1020 of Circ 230 says a practitioner must, on a proper and lawful request by a duly authorized officer or employee of the IRS, submit records or information in any matter before the IRS unless the practitioner believes in good faith and on reasonable grounds that the records or information are privileged. So there's something called attorney-client privilege that attorneys enjoy, which is they do not have to release their conversations, their discussions, their notes and records with their clients to whoever is trying to apply jurisdiction against them. CPAs do not enjoy that sort of privilege. Okay, Section 1021. A practitioner who, having been retained by a client with respect to a matter administered by the IRS, knows that the client has not complied with the rules or has made an error or omission, they must advise the client promptly of that fact. They should advise the client of the consequences of that fact. However, they should in no way provide that information to the IRS unless they have been subpoenaed to do so. Okay, so if you have a client and they want to cheat on their tax return, you're to advise the client of that fact. You're to advise them of the consequences of doing so. And then you simply have to decide whether you want to sign the tax return or not. So obviously, if you do not reach the standard for a tax position on that tax return, you should know that you could be penalized. All right, 1022. A practitioner must exercise due diligence in preparing or assisting in the preparation of, approving, and filing tax returns. It is expected that practitioners will use common sense and experience in guiding their conduct. Due diligence basically means taking reasonable steps to ensure actions and information provided are correct, but it does not require a practitioner to in fact be correct. A practitioner can be wrong, but still have conducted the due diligence required under Circ 230. There are additional due diligence requirements when preparing to file returns for taxpayers who are claiming head of household filing status, the earned income tax credit, the child tax credit, the additional child tax credit, or the American Opportunities tax credit. Basically, the IRS now has a new form, I think it's the 8867, that when you're completing any of these things on an individual tax return, you are required to complete the checklist, the due diligence checklist on that form. In general, a practitioner may not charge an unconscionable fee in connection with any matter before the IRS. That largely includes contingent fees. You are not allowed to charge contingent fees for practice before the IRS, except as provided in a handful of sections. What are those exceptions? Services related to an audit, a claim for penalties and interest, and/or actually representing someone in a court case. A practitioner may not endorse or otherwise negotiate a check into an account owned by the practitioner that is issued to a client by the government in respect of a federal tax liability. What that says is, even though you prepared the tax return, you're not allowed to have the refund sent directly to you so that you can cash it and put it in your own bank account. Now, that said, the world is full of tax refund related products and financial products based on taxpayers receiving a tax refund. Financial institutions offer a variety of financial products to taxpayers based on their refunds. These products include something called a refund anticipation loan, which is money borrowed by a taxpayer from the lender based on the taxpayer's anticipated income tax refund, or something called a refund anticipation check, which directs the refund to a financial institution which disperses fees and then the balance, if there's any left over, to the taxpayer. So generally speaking, the average fee for this sort of thing is about $60. So $60 on a $1,000 refund is not a 6% fee. That's actually a fee of about 42% interest, because all that's happening is you're advancing that loan for generally about 3 weeks. So to charge someone $60 for loaning them $1,000 for 3 weeks is about a 42% interest rate. These are terrible instruments to enter into, and I issue abundant caution against using them. Standards with respect to tax returns and documents, affidavits, and other papers. Okay, so with tax returns and advice, a practitioner may not willfully, recklessly, or through gross incompetence sign a tax return, claim for refund, or advise a client to take a tax position that they know or reasonably should have known contains a position that lacks a reasonable basis. So there's that term again, lacks a reasonable basis. It is an unreasonable position as described in section 6694. Aha, okay, so remember when we talked about way back under the AICPA Standard 1, it said that to the extent there is a standard that the taxing authority uses. Well, here it is. It's either it lacks a reasonable basis or it's unreasonable with respect to 6694, which we'll talk about in a second. Or, of course, is a willful attempt to understate tax liability or a reckless or intentional disregard of rules. So what does 6694 say? It says if a tax return preparer prepares any return or claim of refund with respect to which any part of understatement of liability is due to a position described in paragraph 2, and they knew or reasonably should have known of the position, then they are going to pay a penalty with respect to each return or claim in an amount equal to the greater of $1,000 or 50% of the income derived or to be derived by the tax return preparer with respect to the return or claim. So tax return preparers can be penalized. So now we need to know, what is that position described in paragraph 2? Paragraph 2 says an unreasonable position is a position unless there is or was substantial authority for that position. If the position was disclosed and there is a reasonable basis for the position, then it's okay. So the good news is the AICPA have largely triggered the same standards, except that the IRS uses this thing called substantial authority. If the position is with respect to a tax shelter, then it must meet a more likely than not standard, which is higher than substantial authority. Okay, so what is substantial authority? Only the following are authority for purposes of determining whether a substantial authority for the tax treatment of an item. So what you're required to do is go out and research and find some form of authority that supports your position. And it can be in any number of different sources. So the Internal Revenue Code, the regulations, revenue rulings and revenue procedures, any tax treaties, any court cases, congressional intent as reflected in committee reports, explanations of tax legislation prepared by the Joint Committee on Taxation, any letter rulings, any actions on decisions, any GCMs, any Internal Revenue Service information or press releases, notices, announcements that are published in the Internal Revenue Bulletin. Conclusions reached in treatises, legal periodicals, legal opinions, or opinions rendered by tax professionals are not considered substantial authority. You need to base your decision, your tax position, on one of these items. And if you go back through the sources of tax law, you're going to see these are all the sources of tax law. Okay, what about California? California has the Board of Accountancy statutes. These are the 5,000s. And it also has the tax preparer rules in the 22,000s. And basically it says tax preparers committing any fraudulent, dishonest, or corrupt act that is substantially related to the qualifications, functions, or duties of a registrant can have their license pulled. Under the Accountancy Act, which is a higher standard, that's for CPAs, any crime related to the qualifications, functions, or duties of public accounting or being a CPA, or to acts or activities in the course and scope of the practice of public accountancy, any general negligence or gross negligence of the duties can also cause you to lose your license. So California, Maryland, New York, Oregon, and Connecticut are the only states that have standards for tax preparers. So California has something called the CTEC, which requires a tax preparer to take a course, initially 60 hours, and then 20 hours per year, and get a bond, and of course get registered. Maryland requires tax preparers to pass a test. New York requires them to take a course. It's 16 hours to start, and then 4 per year. And in Oregon, you have to take an 80-hour course and pass the test. Connecticut's standard is forthcoming. Okay, so now we can circle all the way back to Statements for Standards on Tax Services number 1. So if you are a CPA, EA, lawyer, member of the AICPA, or other enrolled preparer, you must meet the substantial authority standard to avoid penalty. If you are an unenrolled preparer, in California, you have to meet the basic standards of professional behavior. If you are an unenrolled preparer in any of the states that do not have standards, then there is no standard. The other SSTS are interesting. You should answer any questions on the tax return. That makes sense. You can, in good faith, rely without verification on information furnished by the taxpayers or by third parties, unless you think that you have some reason to believe that information is misleading or incorrect. You can just rely on it. So if someone walks in with a napkin where they've written all their charitable deductions on the napkin, if they all seem reasonable to you, that can serve as support for the charitable deduction, the charitable contribution deduction on an individual tax return. Taxpayers can use estimates. Yeah, absolutely. And the tax return position with respect to an item as determined in an administrative proceeding or court decision does not restrict a member from recommending a different tax position in a later year's return, but you need to be prepared to distinguish why that later year is different. Number 6 is one of my favorites. A member should inform the taxpayer promptly upon becoming aware of an error in a previously filed return, an error in a return that is subject of an administrative proceeding, which is an audit, or a taxpayer's failure to file a required return. Okay, so notice that it says they need to inform the taxpayer. That's consistent with what we saw in Circular 230. A member should also advise the taxpayer of the potential consequences of the error. Same and consistent as Circular 230. The member is not allowed to inform the taxing authority without the taxpayer's permission, except when required by law. Also consistent with Circular 230. A member should use professional judgment to ensure that a tax advice provided to a taxpayer reflects competence and appropriately serves the taxpayer's needs. Okay, the last thing we're going to do is a comprehensive problem. So what I'd like you to do is pause the video, go out, see if you can calculate Letitia's total income. What is Letitia's taxable income, ignoring self-employment taxes? And then what is Letitia's income tax liability based on this information? Pause your video, go out, do it, and then I'll work the solution in Excel for you. Well, hopefully you actually went out and did it. But if you didn't, here's the answer anyway. All right, so Letitia had wages of $70,000. She had interest from her savings account of $400. She had interest from bonds of $500. Business income of $30,000 and business deductions of $14,500. That yields total income of $86,400. However, part of that interest was on tax-exempt bonds. Therefore, her gross income is only $85,900. There was no information that would have yielded any 4 AGI deductions. So as a result, her adjusted gross income is also $85,900. She had itemized deductions of $14,000. That's greater than her standard deduction, which for a single taxpayer in 2018 would be only $12,000. And then if you were really on your A game, which I wouldn't have expected any of you to be on your A game, you also could have calculated her QBI deduction. So note that she had business income. That was self-employed business income. She's eligible for the QBI deduction of 20% times that amount. That yields taxable income of $68,800. Okay, now we would need to calculate her tax liability. As a single taxpayer at $68,800, Letitia is clearly in this tax bracket, right? So let's just go in and make this, we'll do ourselves a favor, $68,800, and calculate her tax. She's got no, well, she did have $500 of tax-exempt income. There we go. So her tax is $11,075.50. That's the $68,800 less the $38,700, multiplied by 22% plus the $45,53.50. Okay, that brings us to the end of the Chapter 1 video lecture. Thanks for watching.